Hi, this is Nick here, and I'm about to go through the update of the U.S. business cycle chart book. So starting with the U.S. LEIs year over year, we've had an uptick since last month's report to a pace of 6.3%. That's up from 5.8% last month. You can see here that it looks like this rate of change might be leveling off, and we may in fact start to see that trending lower. What's important to note is that the index level itself is still making new all-time highs. So this shaded area represents the year-over-year rate of change of that index. The index level itself does continue to make new all-time highs, and I've included the blurb here from the conference board, which you can read on this slide or on the PDF. Then moving on to the yield curve steepness. So the yield curve is still positively sloped, meaning that the 10-year yield is higher than the 3-year yield. It does continue to trend lower. It looks like we're approaching inversion maybe before the end of the year or early next year. That's at least what the trend suggests. Then in terms of PMI, so we had upside surprises in both the manufacturing PMI and the services PMI data. So you can see here that the manufacturing PMI came out at 61.3. That was up from 58.1 prior. It was also higher than expected and made a new high for the cycle. So going back to 2009, that is, you can see a new high. And that is generally a very positive sign for the growth outlook. Then in terms of the global growth backdrop, so here we have global PMIs, global manufacturing PMIs. You can see the U.S. is kind of starting to stand out here at the high end of the range. That being said, all of these PMI readings, which really represent the largest economies in the world, are all above 50, which is all expansionary territory with the exception of Russia, which is still below 50 and has been for the past 4 months. Then we got the jobs report last Friday. The unemployment rate remained unchanged at 3.9%. It is still below its 12-month moving average. So the picture looks still relatively positive in terms of the labor market. That's also being confirmed by the San Francisco Fed model, which is designed to be a leading indicator for the U3 unemployment rate. So that's the gray line here, and that model suggests it's continuing to make new lows for the cycle, and that suggests that we might see the U3 rate continue to trend lower as well. Then in terms of U.S. labor market capacity utilization, it does appear based on the estimates of the natural rate of unemployment that we're below that. So that suggests that the economy could be operating above capacity, which can lead to an overheating situation. That is also supported by the GDP output gap picture. So with the updated numbers here, you can see the output gap has fully closed. We're now above potential GDP. Basically, that's the first time in the cycle. You've got some revised numbers here that are suggesting this output gap is officially now closed, which is a late cycle indicator. Probably increases the recession risk over the next kind of 1 to 5 year period. Then the Atlanta Fed GDP Now forecast, for what this is worth, this has remained elevated. So this is the Q3 estimate, currently at 4.4%. So we're now in the early part of September, which is the last month of Q3. The Q2 number, we got the second reading on that. That's at 4.2%. So if this GDP forecast is any indication, it could be that the Q3 number is similar to the Q1 number in the low 4% range. Then U.S. household credit cycle. So we did get a new data point on this. This is a quarterly series. The New York Fed puts this out. It's the household debt survey. And the delinquency rate is hitting a new cycle low, which is a generally positive sign for the economy. So you can see here the 3-quarter moving average is the black line. That's continuing to trend lower and to stay below the 6-quarter moving average. I'm looking for a crossover there to get negative on the interpretation for this picture. Then consumer confidence. We're seeing one measure continue to make new highs. That's the conference board measure. The University of Michigan consumer sentiment reading is looking a little bit less certain. That seems to be leveling off, perhaps starting to trend lower. So kind of a neutral interpretation on this picture. And then in general, at elevated levels, these indicators can be somewhat contrarian and suggest a medium-term risk for the economy. Then also got an update on this quarterly series, which is the Fed's Senior Loan Officer Opinion Survey. So banks continue to ease lending standards, and this is generally supportive of the economy. So this picture also looks positive for economic growth. The high yield spread, that's been in a range here and remained below 375. Kind of right now we're in the middle of that range, so it's generally at a low level. And yeah, seeing this break out to the upside would start to get me negative on this picture, which historically has tended to happen after yield curve inversion, so we'll be watching out for that. Then to review the checklist here, I won't go through every item, but generally still positive on most items, with the exception of these medium to longer term indicators that I mentioned, the output gap being closed and the labor force capacity utilization looking like maybe the unemployment rate is below the natural rate. And then you can view the PDF for the full summary write-up.